Firms and individuals require access to credit to meet their respective needs. The financial sector provides a system that facilitates growth and development. Economic policies regulate that system in the hope of ensuring stability. Risk is the likelihood of an outcome occurring where the probability and potential impact can be measured and managed. Whereas uncertainty is the condition where outcomes or probabilities cannot be accurately predicted or quantified. The impact of shocks on the financial sector are increased volatility, reduced confidence, and potential instability across markets and institutions. Exchange rates are the value of one currency measured against another, determined by supply and demand in foreign exchange markets. The risks that exchange rates impose on the financial sector are losses from currency fluctuations that affect international trade, investment returns, and balance sheets. Forward markets are financial markets where contracts are agreed to exchange currencies or assets at a fixed future date and price. The impact of forward markets on the financial sector are greater stability and predictability as firms can hedge against adverse price movements. The role of insurance in business is to reduce financial exposure by transferring risk to insurers, allowing firms to operate with greater certainty. The role of the financial sector is to mobilize savings for lending to firms and individuals, lend to businesses for investment in working capital, lend to individuals, facilitate the exchange of goods and services, assess creditor risk, provide forward markets in currencies and commodities, and provide a market for equities. The role of the financial sector to mobilize savings for lending to firms and individuals is to collect deposits from savers and channel them to borrowers through banks and other financial institutions. The role of the financial sector to lend to businesses for investment in working capital is to provide short-term and long-term finance that allows firms to manage cash flow, purchase inputs, and expand production. The role of the financial sector to lend to individuals is to offer credit such as loans and mortgages that enable households to finance consumption and major purchases over time. The role of the financial sector to facilitate the exchange of goods and services is to provide payment systems and financial infrastructure that allow transactions to take place efficiently and securely. The role of the financial sector to assess creditor risk is to evaluate the likelihood of borrowers repaying loans by using information, credit checks, and risk assessment techniques. The role of the financial sector to provide forward markets in currencies and commodities is to allow firms to hedge against future price changes by fixing prices in advance. The role of the financial sector to provide a market for equities is to enable companies to raise capital by selling shares and allow investors to buy and sell ownership stakes. The central bank is the national institution responsible for managing a country's monetary system, maintaining financial stability, and overseeing the banking system. The role of the central bank is the setting of the official interest rate through the Monetary Policy Committee, the implementation of monetary policy to control inflation, the regulation of the banking industry through the Bank of England's Financial Policy Committee, and acting as banker to the banks as lender of last resort. The role of the Monetary Policy Committee in setting the official interest base rate is to influence borrowing and spending by adjusting rates through regular meetings based on economic data and forecasts. The implementation of monetary policy to control inflation is achieved by the central bank using tools such as interest rate changes and asset purchases to keep inflation close to its target. Regulation of the banking industry by the Bank of England's Financial Policy Committee is to reduce systemic risk by monitoring financial stability and imposing rules such as capital requirements on banks. Banker to the banks as lender of last resort is the role where the central bank provides emergency liquidity to financial institutions facing short-term funding problems to prevent wider financial collapse. The global financial crisis was a severe worldwide economic downturn triggered by instability in the financial system and the collapse of major financial institutions in 2007 to 2009. The contributing factors were subprime mortgages, moral hazard linked to institutions seen as too big to fail, the collapse of lending to businesses, speculation and market bubbles, and the role of organizational culture. Subprime mortgages contributed to the global financial crisis by extending high-risk loans to borrowers unable to repay, leading to widespread defaults and falling asset values. Moral hazard linked to institutions seen as too big to fail contributed to the global financial crisis by encouraging excessive risk-taking as banks expected government bailouts if they failed. The collapse of lending to businesses contributed to the global financial crisis by restricting investment, reducing production, and increasing unemployment across economies. Speculation and market bubbles contributed to the global financial crisis by inflating asset prices beyond their true value, followed by sharp corrections that destabilized financial markets. The role of organizational culture contributed to the global financial crisis by promoting short-term profit-seeking and excessive risk-taking within financial institutions. The role of banking regulation during the global financial crisis was weak and insufficient, allowing risky practices to develop without effective oversight. The impact of the financial sector on economic agents during the global financial crisis was rising unemployment, falling incomes, reduced access to credit, and increased economic insecurity. The impact of the financial sector on governments during the global financial crisis was higher public debt and budget deficits due to bank bailouts and economic stimulus measures. Thank you for watching this video on risk and the financial sector. I'll see you in the next one.